Now, again, before we turn to our final segment, we'd like to remind you, please like, share, subscribe. And this is going to be, this segment's going to go through a lot of different components on China and what's happening in Asia and the recent trade deal. So if you have any questions, comments, please leave them in the comment section. We'd love to hear from you, our loyal followers and listeners. So, as we go through, first, I thought this was an interesting backdrop of following Biden's victory. How are people viewing us? How do people view the U.S.? And it's interesting because obviously everyone likes to talk negative on Trump, but there was a bump. Don't get me wrong. You can see a bump overall, but a lot of our friends still stayed our friends. And that's never going to change because there's a certain amount of unity between, centuries of unity and working together, and that's only gotten more firm over the last few decades, especially as the cooperation with, on the military side, intelligence gathering and others continues to grow. So when we look, the ones that I'd want to start with, just to hone in on some specific sides. Obviously, Europe. There's a lot of there was a big bump in terms of the increase in favorability when we look at Europe, and that comes back to NATO and some adjustments to potential not sanctions, but tariffs. The bigger ones is really India and China. So clearly you can see here, India, not much has changed for the most part because we have definitely cultivated a better relationship ever since let's just say the 60s into the 80s, when we were really supportive of Taliban against the Russians, and India obviously wasn't on the same side as that investment, if you will. But when we look at time, things have changed. We've built a better relationship with India overall. But the interesting side is China. So with that, they've lost about 6%, about 75% now view us unfavorably versus with Trump about 70%. And that is, I think, telling, because my concern was always what will happen with Biden. Will Biden be tough on China that we've really created? And if we look at, as I said in last week's China's episode, I talked about how, Obama learned. He was green when he came in. First 4 years was a bit more apologetic than I think a lot of us would have liked, but that started to toughen up into the second term, and I don't think that'll change with Biden. I'm hoping at least that will remain firm, because there is a certain amount of preparation that is happening, at least on the Chinese side, in terms of a Cold War, and I think it's time that we recognize that their things aren't as friendly as they once appeared, and there's lines in the sand that are being drawn. When China attacked India, Russia, not to say that Russia's anyone's friend, but Russia supported India within an hour. And I think obviously they're more concerned with China than anything else, even though we like to talk about Russia and Europe and NATO. But China's real concern is Russia and China. When you look at China claims several areas within Russia as their own. That's a problem. The Chinese military is not marching into the U.S. They have to get across an ocean. They can march into Russia. And those are things that we have to consider when we start looking at some of these different pieces, because you can say, oh, well, Russia, we lost 7%. 41% thought us unfavorable with Trump. Now it's 45%. So we're not seeing a huge shift. The bigger one to look at is China, because there is a significant problem as we're going forward, and we need friends. So the bumps that we're seeing in Europe are a positive, because we're going to need allies in this longer term, drawn out, whether it's a Cold War, a hot war, a tenuous relationship. Something will be happening for the next decade at a minimum in terms of the way we do business with China on a go-forward level. And this is one of the, I think, an interesting thing to look at is globalization. So when we talk about globalization, who's going to be impacted the most? The U.S. is fairly, I don't want to say self-sufficient, because we're not. We do rely a lot on imports, but we have a lot of those partnerships that we've been talking, that have been cultivated over decades, where China doesn't. And that's what they're trying to do. And we'll talk about the new trade deal. But China's the one that's going to see the biggest impact. Obviously, India, other parts of the Middle East, Russia. There's always going to be an impact when you see problems arising. But China is the one that will have the biggest, or I should say the largest impact to GDP if globalization goes away or adjusts in any shape, way, or form. And this is something to consider when as we talked about and as we were writing about, which comes out on Friday, the Belt and Road Initiative, Made in China 2025, the dual circulation system. All of these come in because they want to be more like the U.S. and more self-sufficient because they're too open to outside impacts. And this is something that I think is important when we're thinking on ways to, I don't want to say penalize, but ways to work with China that forces them to either adjust their ways and or come to the table and have a real negotiation, because there can be a detriment created or pushed upon China for not participating in a legal and or ethical level. And that's something that I think is lost at times when we're looking at the way in which we deal with China. Now, before we go into China and the trade deal in more specifics, we have to appreciate what are some of the partners within this new trade agreement that has been formed in Asia. First off, we have to look at Japan. The Japan business spending quarter over quarter was surveyed to be down 2.9%, was actually down 3.4%. Again, the issues continue to arise in some of these areas that are supposed to be, let's just call it economic juggernauts. The U.S. is number one, China is number two, Germany, Japan, 3 and 4. But we know Germany's struggling, Japan's still struggling. So where are we going to see this real rejuvenation in the emerging markets, in the developed world? Because this is something that I think is important when you're thinking about overall spending within Japan going forward. And that comes into exports, imports. Exports were expected to be down 4.5%. They surprised to the upside. They were only down 2.2%. Imports, though, were supposed to be down 8.8%. Instead, they were down 13.3%. The problem is imports lead to exports, especially in a place like Japan, where they import semi-finished goods, raw materials, export the final product. We know the local consumer is still struggling, so the international market is a key point for them. And here this is where that backdrop comes in, where imports start to slow or miss expectations, and then exports start to slow down. They happen together, and especially with the amount of inventory that has been building up, or at least normalizing, this is something that we have to consider, which is why Japan coming into an agreement with China, maybe there's some opportunity. So you could say, okay, well, Japan signed this deal with China, but they also signed a mutual defense agreement with Australia. And when you look at Japan and Australia signing an agreement, you have to consider, well, okay, they'll sign a deal with China in terms of trade, but they also signed it with other countries that they open up, not just China. They're obviously the largest, but they also signed a mutual military defense with Australia. That's a key component as to how do you balance this move, because there's a lot at stake, especially because the U.S. has been 90% of their military since World War II. So there is something to look at and say, okay, well, where is this relationship going? How is it developing? And how do you then hedge your risk? And I think that's an interesting component that we have to appreciate. Then when we go to India, so now India exports missed year over year. They were down 5.1%. Again, coming full circle to, you had a nice bounce off the bottom, and now we're starting to see some pain. Now we're starting to see some of this kind of drawn out recovery, especially as their main trade partners continue to struggle under the likes of either COVID and or some just economic headwinds. And then when we look at India's CPI, or the consumer price index, you can see inflation fears are starting to increase. Inflation's going up. The survey was 7.3%. It came in at 7.6%. Not a huge miss, but something to consider when you're thinking about easing central bank activity, inflation in general. These are going to limit the amount of stimulus that India can roll out, given some pressures within the market. And this is something to consider when we're looking at emerging markets and frontier markets. How much can they really ease? How much can they really stimulate without seeing some sort of significant pain in terms of inflation and/or prices getting out of control, which is why they have to manage their portfolios in such a way. And it's easy to forget that China is something very similar. So when we shift over and now we look at China's fiscal balance and budgetary targets, you can see 2020 is very ugly, and it's getting worse given the amount of stimulus they have to continue to push into the market. So not only is the fiscal balance and budget getting worse because of tax revenue, stimulus going into whether it be special interest loans or supporting the PBOC and/or local banks or local companies to hire people back. There's also a liquidity problem. So when we look at Chinese conglomerates like Paaniq Guan underscoring concerns, and when we look at that, it's like, okay, well, what are we talking about? Like, what are the concerns? Well, they're insolvent. They declared bankruptcy. Bonds from at least 44 companies totaling $42.9 billion US face repayment pressure, a 23% jump from the tally at the end of March. So we have about $43 billion worth of repayment pressure across large Chinese conglomerates. So who's going to backstop that? Who's going to backstop that debt? It's going to end up everything, especially on the state-owned side, because these Chinese conglomerates are mostly Chinese-owned and/or China CCP backed. They're going to require a bailout. Who provides that bailout? Well, it goes to the PBOC. Well, who's going to provide that? Who's going to print that money? And if you start printing that renminbi or that yuan, depending on where those bonds have to be repaid, is it in dollars? We've seen them sell. They're at their lowest level now for U.S. Treasuries, and everyone's like, oh, it's them trying to pin the U.S. into a corner. No, they need dollars. They need U.S. dollars pulled forward to solidify because they need to print. And if they're going to print, they need to make sure that there's something behind it because they've been issuing debt like drunken sailors. And now they're realizing that the debt and the loans that they gave out are being either financed by tax revenue or are completely underwater because the asset and/or revenue generation isn't what it was supposed to be or expected to be and is missing now. So they have to fill that void by rolling debt. These are the underlying issues that we have to consider as we start to talk about where China is on their recovery. What does that recovery really look like? And are the numbers real? And that's when we start talking about, okay, Chinese fixed asset investment. You can see that going back to 2018, they've been revising previous numbers. So that may say, all right, well, then how we know that the numbers now are questionable at best. But then when we look at the year-over-year numbers, they all of a sudden look great, or they're streamlined, or they're flattish. And it's because they're actually rewriting previous years in order to make this year look better than it really was. So then the question is, well, was 2018 or 2019 really that weak? And now they're just recognizing it? Or is there something where they're just trying to play a game of hide the problem? And it's probably a mixture of both. Maybe they were overstated. There's new data. There's new means of doing it. And now they're taking it down. But how do you have faith in these numbers? When we look at the data coming out of the ports, when we look at the flow of ships, nothing ever really makes sense. There's always something that it's like, well, that seems a little high, but okay. And then you start to dig in a little bit more, and it's like, no, that's an inflated number. There's something wrong there. And it's hard to pin down where, but now that the issues are growing, it's starting to get a little bit easier to say, oh, that's where it is. And it's because they're cherry picking what they're adjusting. And it's starting to get easier to find that cherry picking. Now, when we look at, and speaking of cherry picking, you look at industrial production, the fixed investment and retail sales, and you can see retail sales are still struggling because retail sales missed estimates, and it included Golden Week. So yes, were retail sales up? They were, but how much were they up? It included Golden Week, and you revised the previous year down. So what really was the benefit? What really did we see? Because if you remember from weeks ago, we showed on how Golden Week was down year over year. Now you're saying that sales are up year over year. Well, how can you miss Golden Week sales by that much and really close that gap unless you reduce? And this is where the questions start to come in. Like, what is real and what can we actually try to pin down to say this makes a lot of sense? Because you can build a ton of ghost cities, and the first 50 may be great, the first 100 may be fine, and then it starts to get harder and harder to hide and to build things just for the sake of building things, because then the asset's not generating anything, and you can only print so much because they aren't the U.S. They don't have as Powell has shown us, the printing press to oblivion. There's a certain amount of concern and people view it specifically, and that's why you have to look at some of this data with a fine-tooth comb. And then when we look at productivity slowed. So we continue to see productivity slowing, total factory production, percentage change on the year, that we go into 81, then to 2001 to 2010, then from 11 to 17. Again, when things started to shift, we had a big issue in 2014 where some of the numbers were getting better. You can't deny that. Money was flowing into China, foreign investment. But 2014 was a pivot point. And then that's when the numbers started to get a little bit more questionable. And there's a great, in the report, we go into more detail as to what 2014 was and why was that was the pivot and how things have really gone downhill for the last 6 years or so. But again, nothing dies in a straight line. It wasn't like it was a straight line down. There were some periods in 2016 where they gunned it again. They increased a ton of, they issued a ton of new debt. They stimulated the economy, and things went really well again. The problem is the market continues to say, well, China's going to save us this time again. And it's not as easy as that as we go forward, which is why when we start looking at the RCEP, and so the recent deal that was created in terms of where things are going to go over the next few years. So when we look at the 16 countries, so the 10 members of the ASEAN, which is Brunei, Cambodia, Indonesia, Laos, Malaysia, Myanmar, the Philippines, Singapore, Thailand, and Vietnam, plus the 6 countries in which their ASEAN is the free trade, which is Australia, China, Japan, Korea, and New Zealand, because India opted out, even though there's language that will allow India to step in. And it's just the regional comprehensive economic partnership. So there's all types of benefits. This is the beginning stage of walking back tariffs, adjusting trade flows, allowing for a bit more free trade. And this is the share of world GDP within it. So clearly there is a huge amount of benefits that come from it, especially China opening up some other areas. But this is going to be interesting because this is the first step that the U.S. is not a part of, India is not a part of. And China has the ability, just based on their sheer size, to really dictate some of their terms. And the question will be, how much does China really want to dictate? Because when we look at Chinese trade partners, and let's just take Q2, so Q2 2020, you can see that based on the deal that was struck, you have Japan, South Korea, Hong Kong, Australia, Vietnam, all in the top 7. So there's something to be said about where things are. If we go into the top 15, you pick up Malaysia, Thailand. So clearly there's an incentive for China to come up with a way, again, to insulate themselves from the West, insulate themselves from potential impacts from the U.S. And maybe they force, okay, well, if you want to do business with me, it has to be in yuan, which gets away from the dollar, gets away from the eyes of the SWIFT vehicle that we could easily ping and create some sort of problems in terms of financing and the use of dollars. These are things to consider, but obviously the U.S. is still a huge part of the Chinese trade. And you could say, well, that's an issue for the U.S. as well. It's a mutual problem. And that's why you can't look at where China has all the cards and the U.S. has all the cards. Each one can damage each other in different ways. And the question is, who's preparing for a potential shakeout, a potential problem, or some sort of a failing relationship. And that's something that we have to consider as we go forward to build up new trade partners and really address this. Because when we look at the trade agreement, so who does the U.S. have a comprehensive and progressive agreement, or the Trans-Pacific Partnership? You can clearly see where there's the overhang. And then the regional comprehensive economic partnership with India. And you can see now the U.S. and India are obviously a big part of trade within the region. There's overlap with some key countries, and there's countries that are left out. China and India have to come to a way to also come up with an agreement. And you could say that President Trump walked away from the trade deal, but now we're resetting. What can we do to come together? Because a lot of these countries are also concerned about South China Sea activity, China's activity and aggression in some of these regions, specifically Thailand and Vietnam. So these are opportunities that we can take and really build out and cultivate to limit some of the opportunities that China has and limit some of their spread of the yuan currency. And not to begrudge this point because we talked a lot about it last week, but when we look at chip manufacturing, China wants to increase their growth. And right now they're importing a lot from Taiwan, they're importing a lot from Korea, they're importing from Japan, but they want to import nothing. They want to create their own chips, their own self-sufficient. And if you want to learn more about what this means in terms of foundries and creations, please watch last week's show because we go through this in grave detail. But this is an important prospect when we consider the dual circulation system. And when we look at chip manufacturing in the US, 12% of chip manufacturing is in the US, but chip design software is 85%. Chip design intellectual property, 52%. Manufacturing equipment, 50%. So we may not manufacture the chip, but we're making it. We're creating it. We're building the software. There's a lot of IP behind this that we are keeping for ourselves, and that's what China wants to do. There's a certain amount of creation which comes to the dual circulation system. We want to be like the US. We want to be self-sufficient, not only on raw materials, but also software, on IP, on creation of something new and innovative that we don't have to import. And that's China's focus. So yes, chip manufacturing is important, but these other pieces are also very important. And if not, and at times maybe even more important when we're considering something that might go into a missile or a server or some sort of sensitive material that we don't want to really share or decide who we share with. And these are interesting capacities for when we look going forward. Now, coming full circle to the completion of the deal, we can look at car sales. Like Chinese car sales have recovered, but a lot of them haven't. Well, how much did Chinese sales recover? You can always go to how they kind of missed the system in terms of sales versus registrations and how you can kind of muddy those waters. But the overall view is Thailand, Japan, in terms of car sales, the opportunity is there to increase, again, trade. Because right now, just to give an example, in order for Indonesia to sell into Japan, there'll have to be a certain amount of Japanese components. In order for Indonesia to sell into China, there has to be a certain amount of different components that are Chinese or Japanese. So something similar or the same product has to be made differently in order to get and meet the requirements to say it's made here and it's using the local parts. This agreement gets rid of those. It makes it very easy. So it streamlines the manufacturing process, which inherently will reduce cost, will streamline the asset and make it more accretive for the company and the country of origin, which is some of those benefits. And these are things we have to consider when we start to go through our own trade deal within Asia, our own ways of increasing our relationship with some of our future partners and ways to mitigate against the expansion of China within the region, because it's important not only for raw materials and for U.S. interests, but it's also a point of a lot of growth. And that's something that we can't forget when we're looking at India, Thailand, Indonesia, Malaysia, Japan, Australia, the Philippines. These are areas we have to consider as future growth really starts to ignite. And when we look at, why does China care? Where are some of the issues? When we look at government bond yields, they continue to shift higher, and the renminbi continues to strengthen and the yuan strengthens against the dollar. Again, renminbi versus yuan inside versus outside of China. There's things to pay attention to, and these are things that China is looking at because people are buying bonds, but the question is how will they continue to let the yield rise, or will they step in the way and say, no, the yield can't keep going up. We have to adjust this because then it's getting too expensive and we want to be competitive. This is going to be an interesting backdrop as we look at the US dollar versus the renminbi versus other emerging market currencies with these different compacts and impacts, especially when we're looking at a dual circulation system, because you want to live within the system, but you still have to import from abroad. And you're trying to purchase with yuan, but if your inflation is going up or not secure, then people will be less likely to want to deal within your currency. So there's a lot of nuances that come into actually trading within a specific currency that I think really needs to be drilled into and appreciated a bit more, because it's a lot easier said than done. And we've talked about in last week's episode about the US dollar and how it's ingrained as a reserve currency and it's not going to go away tomorrow, but there's ways to mitigate against that, or ways to minimize its needs. And this is one of them. The RCEP is a way to get away from some of those strengths, or maybe countries might want to continue to trade in it because it's secure, or they have the FX reserves to backstop it. And these are things to consider as we revisit our relationship over the next decade or over the next presidency on how we interact with China and how we interact with Asia, because there are a lot of nuances that need to be appreciated in terms of the way this relationship will develop and some of the issues that have happened. Because obviously China has tested some missiles, and then we tested blowing up an ICBM in space. We've increased our presence in the area. We've sold the Harpoon missiles to Taiwan. We now openly have what's called a trip force in Taiwan, which is a small U.S. contingent that is training, but also would act as a trip force. If you come into Taiwan, we will respond because it'll put our people in harm's way. There are a lot of things happening right now that it's not as simple as, oh, China bad, U.S. good, or U.S. bad, China good. There are pieces within this that have to be massaged out, and really we try to go through that in a lot of detail. And you might say, why are we focusing so much on this topic? Because they're the two largest importers of oil. They're the two largest consumers of energy. They're the two largest economies in the world. There are a lot of residual impacts that will come from this that really we need to understand and pick apart, because this will have wide-ranging impacts to not only our own GDP, but also the global GDP and how this really kind of moves on over the next few years. Because I'm not as, let's just say if I told you exactly what I thought, you'd be concerned about the future. So we just want to look at this and be pragmatic and look at the data, be less qualitative, more quantitative, and say, like, look, these are the different scenarios that could come from this, because there's a lot to be had on a good, all good and bad, because there's two sides to every story. So thanks again for watching. We always enjoy these topics. If you have any suggestions, any questions, please reach out. We obviously have our favorite, the Primary Vision Frac Spread Count, coming out on Friday. So thanks again for watching. I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network.